We're just days away from the presentation of the Union Budget 2024, and we've been discussing what could be taken up by Finance Minister Nirmala Sitharaman. Will the thrust on infrastructure and defence continue for one? And from the perspective of the individual taxpayer, will there be any relief provided? But what about the investor? The call to rationalize capital gains tax has been repeated consistently for several years now. And in 2024, there are several reasons why this should be considered. We're going to talk about all of those reasons with our guest today. We've got Pranav Saita, tax partner at EY, joining me in studio. Pranav, thanks so much for taking the time.
Thank you.
To set the context, I want to actually go to my colleague first. We've got Mahima Vajrajani joining us to talk about the treatment of various asset classes and the fact that they are in fact treated very differently when it comes to capital gains tax. Mahima, what can you tell us?
Right, Alex, so I'll straight away start with equities first, where for equities, the short-term capital gain is, if it's short-term capital gain, if it's less than 1 year and more than that is long-term capital gain, the short-term capital gain rate is 15% and LTCG is at 10%. Now, of course, LTCG is exempt up to 1 lakh rupees. For real estate, similarly, short-term capital gain is below 2 years and more than 2 years is long-term capital gain. For in this case, short-term capital gain is taxed at slab rate and LTCG rate is 20% plus indexation. In terms of gold, well, for gold, short-term capital gains is considered when it's less than 3 years and more than 3 years is, of course, long-term capital gain. Similar for gold as well, short-term capital gains is taxed at slab rate, and for long-term capital gain, it's 20% with indexation. Now, in terms of fixed income mutual funds, all gains are taxed at the slab rate. For listed corporate bonds and government bonds, short-term capital gain is considered if it's less than 1 year and more than 1 year is considered as long-term. And in terms of short-term capital gain, it's taxed at slab rates and long-term is at 10% and this is without indexation. And lastly, unlisted debt securities, for this, short-term capital gains is considered when the security is held for less than 3 years, and long-term capital gain when the securities are held for more than 3 years. And for this as well, short-term capital gain is taxed at slab rate and LTCG is at 20% with indexation. So these are the various ways where different asset classes are taxed.
Absolutely. Thanks so much, Mahima, for getting us those details. Now, you've probably experienced this yourself and you've probably had conversations about this. Tax can be a little complicated. But Pranav, is this more complicated than it should be?
Oh, I think so, yes. There's no doubt about it. Even I would have to go back to the book and refer what the tax treatment in certain situations will be, because of the fact that over a period of time, and very legitimately, various things have evolved with the result that it's become quite complex. Depending on the nature of the asset, whether it is financial instruments or otherwise, within financial instruments, what is exactly the nature of the asset? What is the period of holding? Has the transaction been on market or off market? Is it STT paid or not paid? The period of holding, whether it should be 1 year, 2 years, 3 years. And it's gotten quite complex over a period of time just because of the way in which it has evolved. And then again, within the nature of the asset, apart from the status of the SSE, resident, non-resident and so on, whether the nature of the asset, if it is REIT InvIT units, there's certain things for long-term, short-term, 3 years. For other listed securities, it's something else. So it's just getting a little too complicated and people tend to probably go back every time and figure out what exactly will be the tax treatment. That's not a hallmark of a great tax regime. A great tax regime normally should be simple so that the taxpayer pretty much knows very easily what is his likely tax liability in certain situations. So I think there is a need, a real need, to simplify and rationalize the capital gains tax regime rather than have too many categories of assets and too many different treatments. It would be good to have very few categories and very clear logic and rationale for those 3 buckets or 2 or 3 buckets, and the tax rates, the period of holdings and so on being very clearly clarified for each.
We will talk about what an ideal scenario would look at, Pranav, but before we do, I would like to talk about the elephant in the room, if you can call it that, because every time there is buzz about an increase in the capital gains tax on equity, then equity markets react. If at all there is an announcement in the budget pertaining to the increase or the decrease in long-term capital gains tax, then there is a massive reaction. The last time there was a change, it was 2018, but I want to go back all the way to 2004 because this is when long-term capital gains tax was removed. STT, Securities Transaction Tax, was introduced. The interpretation for those that were not really tracking the market or taxation at the time is that one was introduced in lieu of the other. Is that the right interpretation?
Oh, absolutely. And that was very clearly brought out in the finance minister's speech in that year. I think it was Mr. Chidambaram, who introduced the securities transaction tax just to simplify the tax regime and make the collection of taxes also very simple, and for taxpayers not to worry about the tax while deciding whether they are buying, selling, the point of time of buying and selling, and so on. So essentially it was introduced as a simplification measure and as a substitution of the long-term listed securities capital gains tax. And in that year itself, I think the collections were pretty robust. I think it was less than 12,000 crores. But I mean, in fact, 12,000 crores was about in 17-18, if I recall right. And from that itself, in the last 6-7 years, the collections have tripled. In 2004, it was pretty nominal. In 17, I think it was less than 12,000 crores. Now it's expected to be, as per the budget estimates for this year's interim budget, it's expected to be more than 36,000 crores. And if the actual numbers are to be looked at, probably it's going to bust those numbers.
Because we have data from April to June this year, and incidentally, it's a 128% increase on a year-on-year basis. We're talking about 16,000 plus crore rupees just in those 3 months, Pranav.
Correct. So I have no doubts that 36,000 number will be busted in all probability, unless the budget upsets the capital market, so to say, which is unlikely, I think.
So the reason why...
And last year it was 32,000 crores for the full year revised estimate for 23-24. And this year, 3 months, you are saying it's...
Yeah, so this is a factor of the number of investors and the volume of transactions, ultimately, right?
Absolutely.
And with the kind of increase in the participation in the equity markets, you've seen this value go up as well. Now, talk to me about, say, it's 20 years of STT. It's done well, to say the very least. And it will do well. But the reintroduction of long-term capital gains, people were not too happy about that. Of course, there was grandfathering and all of that. But then now there was buzz in the run-up to the budget that it could be raised again. Is there a case for that?
Oh, I don't think it is very likely. Of course, one can never rule out anything. I don't think it is very likely, because I think even the government realizes that this was an addition to the STT in any case. Second, I think there is a realization that Indian investments into productive assets like securities and shares and financial instruments is something that is really charging up the economy. And to an extent even giving a fillip to entrepreneurship. So I personally do not think that this 10% is likely to go up, but yes, indeed there is a buzz, or there is fear, let's put it that way, that it could go up under the guise of simplification and rationalization of the capital gains tax regime. Well, I do think, if at all, one hopes not, but one cannot be sure, if at all, probably the short-term capital gains tax could go up from 15%. But I do not anticipate the long-term capital gains tax going up from 10%, because of the various factors. One, that we are talking of investments in productive assets. It is the domestic investor who has really ensured that capital is available in what was otherwise always regarded as a capital-starved country. So while foreign investments have been really very tempered, very moderate, so to say, if I might say so at all, it is the domestic investors who've kept the capital markets, the flow of capital into business, really sustained. So I don't expect the long-term capital gains tax to go up in this budget. Short-term capital gains tax could be, probably, because of the fact that only 1 year is long-term, and there is a feeling that one wants to probably temper the euphoric mood or the stampede in capital markets, where people want to trade and do even F&O kind of deals and so on. So that tempering probably, and getting a little more longer term mindset, might be the philosophy. And at the same time, 15% looks a real good rate. Of course, with STT in place, even that can be probably debated. But I'm just telling you what probably at worst could happen is my feel.
Based on the share of India and global derivative trade, it wouldn't be an exaggeration to call India a trader's market. But having said that, let's talk about how what you said could pan out. A rationalization of the treatment of capital gains could result in an increase in the tax ultimately. And my curiosity is whether this can take place without even changing the rates. Because if you were to, for example, say that all capital gains will be considered long term if it breaches 2 years or if it breaches 3 years, automatically people selling at less than 2 years will be taxed at 15%. So you're ultimately increasing the tax collection.
Undoubtedly, that also is something that cannot be ruled out. So one is the tax rate, second is the period of holding. One cannot rule that out. And if we look at the international scenario, there are different countries having very different models.
How do they work?
Yeah. So for example, there are some countries who don't distinguish between long term and short term at all, like Canada, UK, and so on. Denmark, for that matter, Indonesia. So they don't differentiate between the two. There are some like US, Australia, etc., which have the 1 year rule. Some countries like France have the 2 year rule for the cutoff between long term and short term. So there are very different models. But I think in India, this 1 year model has worked quite well for a long time. And I would feel this government has focused very rightly on maintaining some form of stability in the tax law, which is a great virtue, because investors, whether in India or abroad, are looking for predictability, are looking for stability, are looking for some form of certainty when they are taking longer term decisions. So I do not think this government is normally induced with the desire to tinker too much. So I'm not anticipating that, but yes, that's another way of probably saying that if you extend the period from 12 months to 24 months, you automatically, within that 1 year, 12 to 24 months, whoever sells pays 15 instead of 10% if the rates remain the same. Certainly a possibility, I wouldn't rule it out, but I hope that's not something that they are looking at.
Okay, so it's not the ideal solution.
I do not think so.
Okay, so before we get into the ideal solution, I also want to talk about this interesting announcement that came, if I'm not mistaken, correct me if I'm wrong, last year, where you're talking about fixed income mutual funds, where you invest in listed corporate bonds, which now it's going to be easier to do because the face value is going to be lower. And the treatment of capital gains there is that if it's less than 3 years, it's going to be short-term capital gains. If it's more than 3 years, you will be taxed at 20% with indexation benefits. The result of which is that your tax incidence is very low, comparatively. Right. But if you invest in the same asset through a mutual fund, everything is considered short-term capital gains and you are taxed at slab rate. Isn't there a bit of an issue here?
So the long-term benefit might still be available, but the indexation is not available because of the amendment that we got last year. And I do feel it's not the ideal thing, because for the simple reason that when it comes to a capital gain, and in an economy like India, to the extent there is no real gain and the gain is nothing but inflation, then to tax that is something that doesn't sound very fair. And therefore, I would feel that when they do rationalize, and I'm hoping that when they do rationalize the capital gains tax regime, one of the things that they would do is not tax just inflation, but tax real income, which is income beyond the indexation or the inflation rate for that period. Right now, I am not too sure whether this budget will restore that particular thing, but whenever they look at a larger revamp and simplification, rationalization of the capital gains tax regime, our ask has always been through various forums that you must have indexation in place, because that's something that ensures that you are not merely taxing inflation. Inflation is something that breaks the back of the middle class anyways, and on top of, or every person really. And on top of that, if it is taxed without any real income or gain being earned by an investor, then that's something which really adds to the agony of the inflation itself. So I would feel that's something that is very important to ensure. And if I look at international investors, they really look at inflation in terms of maybe US dollars or other currencies, right, which over a period of time, of late the US dollar also has seen some inflation, but otherwise over a period of time, the inflation is very muted in some of these currencies. So Indian investors typically lose because of the higher rate of inflation in India, and therefore that needs to be protected from a tax standpoint.
So is my interpretation correct? What you're suggesting is that indexation should be available even on equity?
Okay, so probably yes, but the whole thing there is if they are going to live with a 10% tax and without indexation, which is what the current regime is, I'm not too sure that's what is going to easily happen, because probably what they are trying to say is, okay, STT plus a 10% long-term capital gains tax is a reasonable tax rate. We also have to weigh this and counterbalance this with the fact that if a salaried person is going to pay at normal tax rates, why should long-term capital gains tax be so very beneficially treated? So really the 10% rate plus the STT balances of this point that I just mentioned about equity in taxation, plus the fact that 10% is justified because there's also inflation factor. So I think it just makes life simple to keep it 10%.
And that 1 lakh threshold, do you think they'll tinker with it at all for equity taxation?
I do not think so. In fact, if at all, I would feel there is a case to increase that threshold, because if 1 lakh was something that was true a few years ago, given the inflation, that 1 lakh obviously is much lower today. So there is probably a case of increasing that, like with all other thresholds, but even if they don't, I don't think that is going away.
So that 1 lakh threshold is not just to protect the small investor, it is also to protect you against inflation. Is that the right interpretation?
I would think it's because to a large extent, STT was always meant to be a substitution against capital gains tax. So when they brought capital gains tax back into listed securities, what they said is, okay, for the small investor at least we are honoring that original idea that STT is a substitution for capital gains tax. But for larger gains and for larger investors, probably they said we bring a token 10% tax. That I think was the logic of the rationale.
Okay. To close this conversation out and to round it out, if we can call it that, you've spoken about several aspects, but let's tie it all together.
Sure.
When it comes to the treatment of capital gains and the taxation of capital gains, what is the ideal scenario for India?
So the way I would look at it is not to tinker too much, continue with a stable tax regime, at the same time reduce the complexity and make it, simple and as rationalized as can be possible. I would feel therefore there has to be 2 or maximum 3 buckets into which they could probably divide this.
Asset classes?
Asset classes. One is financial instruments which are risk bearing, if you want 3 classes. If you want 2, then it's just financial instruments and other assets. If you want 3 classes, financial instruments that are risk bearing, other financial investments, and all other investments or assets.
Which is gold and real estate and all
Gold,
that.
real estate, jewelry, works of art, paintings, whatever else you have, right? So all of that can be the third category of other than financial instruments. And I would feel the most favored treatment obviously has to be investments in financial instruments which are risk bearing, because that's where we need capital in a capital starved country like ours, and domestic investors have now caught on to it. So I would feel that has to be the most favored, maybe 15% short term, 10% long term, 1 year period of holding for long term, by and large. The non-risk bearing financial instruments could again be maybe 1 year or 2 years maximum for long term.
This is debt now.
Debt. Financial instruments which are like debt mutual funds or debt instruments or whatever. They could be like, 1 year or maximum 2 years. They could be 20% tax but with indexation benefit. And the short term can be at regular slab rates. That's how I view the financial instruments non-risk bearing, broadly speaking. Because both these are productive assets and they need to get a better treatment. Productive investments and need to get a better treatment. Not that residential houses aren't, and we can debate that. But the third category could be relatively higher tax. For example, it could be for short-term slab rates, for long-term 20% with indexation, and the period of holding could be 3 years or whatever. So that's how I would feel. Keep it very simple, maximum 3, ideally 2 categories of assets, and productive, non-productive, tax it simply.
All right, let's hope that the finance minister is listening, and let's see what pans out. Thank you so much
Thank
for
you.
joining me today.
Thank you. Thank you so much, Alex. Have a
And
good day.
hopefully this conversation has given you some perspective ahead of the presentation of the Union Budget 2024. And if indeed something is announced, then you got your information here. Do stay tuned, lots more coming up over the course of the day. And this is NDTV Profit.